Something has shifted in the financial markets. Not overnight, not without warning, but definitively. If you hold gold or silver right now, you're watching your portfolio experience a volatility that feels unsettling. If you don't hold these assets, you're wondering whether this moment represents opportunity or danger. This video is for both of you. Because what's happening right now in precious metals markets isn't just about price movement, it's about something deeper, something that reveals how markets actually work when larger forces collide. My name doesn't matter. What matters is that you leave this conversation with clarity. Not hype, not fear, just understanding. We're going to walk through what's actually happening in gold and silver markets, why it's happening now, and what it means for anyone trying to preserve wealth in an increasingly complex financial environment. We'll talk about macroeconomic forces, market psychology, and what disciplined investors do when everyone else is panicking. This isn't about getting rich quickly. It's about understanding the moment we're in and responding with intelligence rather than emotion. First, let's establish the facts without drama. Gold and silver prices have experienced sharp declines recently. These aren't minor corrections. These are movements that grab attention, trigger headlines, and cause retail investors to question everything they thought they knew about safe haven assets. Gold, which many investors viewed as a steady hedge against uncertainty, has pulled back from recent highs. Silver, always more volatile than its larger counterpart, has experienced even sharper percentage declines, the kind that make people check their brokerage accounts twice. But here's what most people miss. Price movement alone tells you almost nothing. What matters is context. These declines are happening against a backdrop of rising real interest rates, dollar strength, and shifting expectations around central bank policy. They're happening at a time when institutional positioning had become crowded on one side of the trade. They're happening when sentiment had reached levels that historically precede corrections. In other words, this wasn't random. This was probable. Markets don't move in straight lines. Assets that rise substantially over months or years don't do so without giving back portions of those gains along the way. What we're witnessing is part of a normal market cycle, amplified by modern market structure and accelerated by algorithmic trading. The question isn't whether this decline is happening. The question is what it reveals about the underlying fundamentals and what it means for the road ahead. Let me tell you what happens to most investors during moments like this. They look at a chart going down and assume something is broken. They assume the original thesis was wrong. They assume smart money knows something they don't and is exiting en masse. This is understandable. Our brains are wired to interpret falling prices as danger and rising prices as safety. But in financial markets, this instinct often leads you exactly backward. When gold and silver prices fall sharply, the first thing people forget is why they owned these assets in the first place. They forget that precious metals aren't primarily about price appreciation. They're about wealth preservation across economic cycles. They're about holding something that exists outside the banking system. They're about diversification when traditional assets face structural risks. None of those reasons disappear when prices correct. In fact, if the macroeconomic conditions that initially justified owning gold and silver remain intact or intensify, then lower prices don't represent failure. They represent opportunity for those who understand the difference between price and value. Most people also misunderstand the nature of precious metals markets. These markets are smaller and less liquid than major equity or bond markets. They're more susceptible to technical factors, positioning flows, and short-term sentiment swings. A relatively small amount of selling can create oversized price movements, especially when leveraged positions unwind. This doesn't mean the fundamentals have changed. It means the market structure is doing what it always does during periods of repositioning. Understanding this distinction separates investors who survive market cycles from those who don't. Let's zoom out and talk about the bigger picture. Because short-term price action only makes sense within the context of longer-term forces. We live in a world where sovereign debt levels across developed economies have reached historic proportions. Government spending continues to outpace revenue generation by substantial margins. Central banks have expanded their balance sheets to sizes that would have seemed unimaginable 2 decades ago. These aren't political statements. These are accounting facts. When debt grows faster than the economy that supports it, something eventually has to give. Either growth accelerates dramatically to grow into the debt, or the currency's purchasing power adjusts downward to make the debt more manageable in real terms, or some combination of both occurs alongside financial repression. History offers very few examples of heavily indebted nations simply growing their way out without consequence. What history does show is that currencies tend to lose purchasing power over time, especially when governments face fiscal pressures they can't resolve through growth alone. This is why certain investors hold gold and silver. Not because they expect prices to go up every month, but because they understand that over long enough time horizons, hard assets tend to preserve purchasing power better than paper currencies that can be created without limit. That fundamental reality hasn't changed because prices corrected. Now, let's talk about interest rates. Real interest rates, Nominal rates minus inflation matter enormously for precious metals. When real rates rise, gold and silver face headwinds because the opportunity cost of holding non-yielding assets increases. We've seen real rates move higher recently as nominal rates remained elevated, while inflation expectations moderated. This creates mathematical pressure on precious metals prices in the short to medium term. But here's what gets overlooked. Real rates don't exist in isolation. They exist within a framework of fiscal sustainability, economic growth prospects, and political willingness to maintain restrictive monetary policy long enough to fully reset the system. If economic growth slows meaningfully, if unemployment rises, if financial conditions tighten to the point of threatening stability, central banks historically respond by cutting rates and expanding liquidity once again. And when that happens, real rates fall, and precious metals typically respond positively. We're not predicting this will happen tomorrow. We're observing that economic cycles exist, that policymakers face impossible choices between inflation control and growth support, and that these dynamics create conditions where hard assets matter over time. The current price decline doesn't change this macro framework. If anything, it makes accumulation more attractive for those with long time horizons. Let's talk about market history. Not to predict the future, but to understand patterns. Every significant bull market in precious metals has included sharp corrections that felt catastrophic in the moment but proved temporary when viewed over longer timeframes. During the 1970s bull market in gold, there were multiple drawdowns exceeding 20%. Investors who sold during those corrections missed the subsequent moves to new highs. Those who understood the underlying monetary conditions and stayed patient were rewarded. During the 2000s bull market, gold experienced corrections of 15 to 30% multiple times. Each time, commentators declared the rally over. Each time, buyers who understood the fundamentals stepped in at lower prices. Silver, with its smaller market size and industrial demand component, has always experienced even more dramatic volatility. 40 to 50% corrections during broader bull markets aren't anomalies. They're features of how silver trades. This doesn't make the corrections pleasant. It doesn't eliminate the psychological difficulty of watching your portfolio value decline, but it does provide perspective. Markets move based on supply and demand, positioning, sentiment, and technical factors in the short term. They move based on fundamentals over longer periods. Right now, we're experiencing the short-term factors overwhelming the screen. Leveraged positions are unwinding. Technical traders are selling breakdowns. Sentiment has shifted from extreme optimism to fear. But the fundamentals, sovereign debt, monetary policy constraints, currency debasement pressures, geopolitical uncertainty, those remain. Investors who understand this distinction and position themselves accordingly. They don't panic during volatility. They prepare for it. They view corrections as natural parts of cycles rather than invalidations of thesis. They also understand something else critical. Markets bottom when sentiment is worst, not when everything feels safe. Here's what separates successful investors from everyone else during moments like this: emotional control. When prices are rising, everything feels easy. Your decisions seem brilliant. You feel validated. The hard part is resisting the urge to overcommit, to add leverage, to assume the rise will continue indefinitely. When prices are falling, everything feels wrong. Your decisions seem foolish. You feel exposed. The hard part is resisting the urge to capitulate, to sell at exactly the wrong time, to abandon a sound strategy because short-term pain clouds judgment. The behavior gap, the difference between what investors should do and what they actually do, is where wealth gets transferred from the impatient to the patient. Right now, many retail investors who bought gold and silver at higher prices are experiencing regret. They're wondering if they should cut losses. They're reading headlines about the crash and feeling like they missed some signal that smarter investors saw. This is exactly the moment where discipline matters most. If you bought precious metals as a hedge, as long-term wealth insurance, as diversification against systemic risk, then short-term price declines don't change your reason for owning them. Unless the fundamental conditions that justify the allocation have reversed, price volatility is noise, not signal. If you bought precious metals hoping to get rich quickly, expecting linear price appreciation without volatility, then this correction is teaching you an important lesson about how these assets actually work. The investors who do well over time are the ones who separate emotion from process. They define their strategy in advance. They understand their time horizon. They size positions appropriately so that volatility doesn't force their hand. They view moments like this not as catastrophes, but as tests of their understanding and conviction. Let's speak directly to those who already own these assets. First, ask yourself why you own them. If the answer is long-term wealth preservation, portfolio diversification, or protection against monetary instability, then short-term price declines are irrelevant to your strategy. The wealth preservation case for precious metals doesn't depend on prices going up every month. It depends on these assets maintaining purchasing power across decades and economic cycles. That case remains intact. If you own physical gold and silver, actual coins or bars, not paper proxies, you own something with no counterparty risk. You own something that has been recognized as valuable for thousands of years across every human civilization. That doesn't change because the price corrected 20%. If you own exposure through ETFs or mining stocks, you have different considerations around volatility and market structure, but the fundamental thesis remains the same. Here's what you shouldn't do. Don't panic sell. Don't make emotional decisions based on short-term price action. Don't abandon a long-term strategy because of temporary volatility. If you sized your position appropriately, meaning you didn't allocate more than you could afford to hold through drawdowns, then this is simply part of owning the asset class. If you overallocated or used leverage, that's a different problem. That's a risk management failure, not an invalidation of precious metals as an asset class. For disciplined holders, this moment is boring. Not comfortable, perhaps, but boring. Because they expected volatility, they planned for it, and they're not making changes based on it. Some holders might even view this as an opportunity to add to positions at lower prices if their broader portfolio allocation strategy calls for it and they have available capital. That's not a prediction. That's just how long-term investors think about assets they believe in when prices fall. Now let's talk to those who don't currently own precious metals. If you've been watching this asset class from the sidelines, wondering whether to allocate, this correction raises important questions. The first question, why would you consider owning gold or silver? If you don't have a clear answer to that question, then you shouldn't own them, regardless of price. Precious metals aren't about speculation. They're not about timing the market or chasing returns. They're about portfolio construction, risk management, and long-term thinking. If your answer involves protecting purchasing power, diversifying away from financial system risk, or holding assets uncorrelated with traditional stocks and bonds, then you have a rational foundation for considering an allocation. The second question, does the current price decline change the fundamental case? If sovereign debt is still growing unsustainably, if central banks still face impossible trade-offs between inflation and growth, if geopolitical tensions remain elevated, if trust in traditional financial institutions remains fragile, then the case for owning some precious metals as part of a diversified portfolio hasn't weakened. If anything, lower entry prices improve the risk-reward profile. But here's critical guidance. Don't rush. Don't try to catch a falling knife. Don't commit your entire allocation in one transaction at what you think is the bottom. Markets can remain oversold longer than seems logical. Prices can fall further than seems reasonable. Trying to time exact bottoms is a fool's errand. If you decide precious metals deserve a place in your portfolio, build the position gradually. Dollar cost average over time. Remove the pressure of getting the timing perfect, and only allocate what you can afford to hold through volatility without losing sleep. If you're not prepared for your position to potentially decline another 10 or 20% before eventually recovering, you're allocating too much. The worst thing you can do is buy during a panic, experience further decline, and then sell at an even worse price because you couldn't handle the volatility. Investing successfully requires matching your positions to your temperament and time horizon. Precious metals are volatile. They go through long periods of going nowhere. They experience sharp corrections during broader bull markets. If you can't handle that, you shouldn't own them, regardless of the fundamental case. You'll see headlines about buying chaos, about retail investors rushing in, about coin dealers running out of inventory, about premiums spiking. Some of this is real. Some of this is marketing. When precious metals prices decline sharply, certain buyers do emerge. Physical market participants who understand the difference between paper prices and physical delivery sometimes see value at lower price levels. Long-term accumulators view corrections as opportunities to acquire more ounces at better prices. This creates temporary dislocations between paper market prices and physical market availability. Dealers sell through inventory quickly. Premiums rise, delivery times extend. But let's be clear about what this means and what it doesn't mean. It doesn't mean prices are about to reverse immediately. It doesn't mean you need to rush in before missing the bottom. It doesn't validate emotional decision-making. What it does mean is that different market participants operate on different time horizons with different strategies. Paper markets are dominated by leveraged traders, algorithms, and short-term positioning. Physical markets are dominated by long-term holders, central banks, and buyers unconcerned with quarterly performance. These markets influence each other, but don't always move in lockstep, especially during periods of volatility. If you're considering buying physical metal and encountering high premiums or limited availability, that's information. It tells you that while paper prices fell, physical demand at those levels is robust, but it doesn't tell you what happens next week or next month. It just tells you that some market participants see value at current levels. The chaos narrative sells clicks. It creates urgency. It triggers fear of missing out. Ignore it. Make decisions based on your strategy, your time horizon, and your understanding of fundamentals, not based on inventory levels at coin dealers or premiums over spot price. Let's talk about what will destroy you during moments like this. First, don't react emotionally. Fear and greed are the enemies of successful investing. When prices fall and you feel panic, that's your signal to pause, not act. When prices rise and you feel euphoric, that's also your signal to pause. Emotional trading is how wealth gets transferred from retail investors to disciplined investors, every single time. Second, don't chase headlines. Financial media makes money by creating urgency and drama. Your job is to filter signal from noise. Most of what you read today will be irrelevant a month from now. Third, don't use leverage. This is critical. Leverage amplifies gains, but also amplifies losses. More importantly, it creates forced selling at exactly the wrong times. When prices move against leveraged positions, margin calls forced liquidation regardless of fundamentals. Some of the current selling pressure in precious metals comes from exactly this dynamic. Leveraged positions built during the rally are now unwinding, creating cascading selling pressure that feeds on itself. If you can't own the position without leverage, you can't afford the position. Fourth, don't blindly follow online hype. Social media is filled with people claiming they know where prices are headed next. Most of them are guessing. Some are deliberately misleading you for their own benefit. Nobody knows where prices go next week or next month. Anyone claiming certainty is either lying or delusional. Fifth, don't abandon your plan because of short-term volatility. If you had a strategy before this correction, and the fundamental reasons for that strategy remain valid, then price volatility shouldn't change your approach. If you didn't have a strategy, that's the actual problem, not the current price action. Sixth, don't over-allocate. Precious metals might represent 5, 10, maybe 15% of a diversified portfolio depending on your situation and risk tolerance. They shouldn't represent 50% unless you're prepared for extraordinary volatility and potential long periods of underperformance. Concentration creates fragility. Diversification creates resilience. Finally, don't expect to time the bottom perfectly. You won't. Nobody will. Trying to catch the exact low is how people end up sitting on the sidelines through entire recovery moves, or making desperate trades that compound losses. If precious metals deserve a place in your portfolio, build the position over time at various price levels. Remove timing pressure. Focus on the long-term allocation, not short-term price optimization. These warnings aren't theoretical. They're based on observing what destroys investor outcomes during every market cycle. The people who lose money aren't usually wrong about the big picture. They're wrong about risk management, position sizing, time horizon, and emotional control. Don't let that be you. Let's talk about how professional investors actually think during uncertain times. They think in probabilities, not certainties. They assign likelihood to various outcomes rather than predicting one future with confidence. What does probability thinking look like in this situation? There's some probability that gold and silver have entered a prolonged bear market, that real rates stay elevated for years, that inflation stays controlled without recession, and that precious metals underperform for a long period. There's some probability that this correction represents a mid-cycle shakeout within an ongoing bull market, that economic weakness eventually forces central bank easing, that fiscal pressures intensify, and that precious metals resume their advance. There's some probability that we're entering a long consolidation period where prices trade sideways with high volatility, but no clear trend. All of these are possible. None are certain. Professional investors don't pretend to know which scenario will unfold. Instead, they construct portfolios that can survive and potentially thrive across multiple scenarios. This is why diversification matters. This is why position sizing matters. This is why having a time horizon longer than the next quarter matters. If you're right about the scenario, but wrong about the timing, overconcentration can still ruin you. If you're approximately right over a long enough period, proper position sizing allows you to benefit while surviving the volatility. Market cycles exist. Assets that decline sharply sometimes decline further before recovering. Sometimes they recover quickly. Sometimes they take years. The honest answer is, we don't know which this is yet. And we don't need to know to make intelligent decisions. What we do know is that reacting to short-term price action with all-in or all-out decisions is usually the wrong approach. What we do know is that fundamentals matter more than price action over long periods. What we do know is that emotional control and risk management determine outcomes more than perfect timing. Focus on what you can control. Position sizing, time horizon, emotional discipline, ongoing education. Accept what you can't control. Short-term price volatility, market sentiment, the timing of cycle turns. This is how you survive and potentially prosper through market cycles rather than getting destroyed by them. Here's what separates investors who build wealth from those who chase it. Long-term thinking isn't about setting a position and ignoring it for decades. It's about making decisions based on time frames that extend beyond the next week, month, or even year. When you think long-term, short-term volatility becomes less relevant. A 20% correction in an asset you plan to hold for 10 years is noise, not catastrophe. When you think long-term, you focus on fundamentals rather than price action. You ask whether the reasons you own something remain valid, not whether the price moved the way you hoped. When you think long-term, you're less susceptible to panic and euphoria. You understand that market cycle, that volatility is the price you pay for long-term returns, that patience is a competitive advantage. Most investors struggle with this. Our brains evolved to respond to immediate threats and opportunities. Market volatility triggers those same survival instincts, making long-term thinking difficult, even when we know it's correct. This is why process matters more than outcomes over short periods. You can make the right decision and still experience short-term losses. You can make the wrong decision and still experience short-term gains. Process, disciplined, probability-based, emotionally controlled decision-making is what determines outcomes over time. If your process for owning precious metals was sound, this correction doesn't invalidate it. If your process was flawed, if you were gambling, speculating without understanding, following hype without research, then this correction is teaching you something valuable. The question is, are you learning the lesson? Long-term thinking also means accepting that you'll be uncomfortable sometimes. You'll experience drawdowns. You'll question decisions. You'll wonder if you're wrong while everyone else seems to be making money doing the opposite. This discomfort is the price of admission for potentially superior long-term outcomes. The investors who can't tolerate this discomfort end up buying high and selling low, chasing performance, abandoning strategies at exactly the wrong times. Don't be that investor. Let me be direct about something important. You are not a passive victim of market forces. You are an active participant making choices. The choice to hold or sell, the choice to buy or wait, the choice to panic or remain calm, the choice to educate yourself or react blindly. These choices matter more than the market's direction over the next month. If you hold precious metals, your role is to maintain perspective, to remember why you own them, to avoid emotional decision-making, to view this as part of the journey rather than a destination. If you're considering buying, your role is to be honest about your motivations, to understand what you're actually buying and why, to size positions appropriately, to think in time frames measured in years, not weeks. If you're on the sidelines, your role is to educate yourself without pressure, to understand that missing a short-term bottom isn't nearly as harmful as making an emotional, poorly thought-out decision. Your role is never to know the future with certainty. That's impossible. Your role is to make informed decisions based on your understanding of fundamentals, your risk tolerance, your time horizon, and your financial situation. Nobody can tell you what the right decision is for you. A financial advisor who knows your specific situation can help. A random person on the internet claiming to know where prices are headed cannot. Take ownership of your decisions. Do the work to understand what you own and why. Accept responsibility for outcomes rather than blaming markets or seeking scapegoats. This is how you develop as an investor. This is how you build the judgment and emotional control that actually matter. So what do disciplined investors actually do during moments like this? First, they review their thesis. Not to abandon it at the first sign of difficulty, but to honestly assess whether the fundamental reasons for their positions remain valid. If the macro environment has changed in ways that invalidate the original reasoning, that's important information. If the macro environment remains broadly consistent with the thesis, then price volatility is just volatility. Second, they review their portfolio allocation. Are they still within their target ranges? Has the decline created an opportunity to rebalance? Has their risk profile remained appropriate, or does something need adjustment? Third, they avoid making dramatic changes based on short-term price action. Small adjustments based on disciplined rebalancing? Fine. Wholesale abandonment of strategy based on one bad month? Destructive. Fourth, they continue educating themselves. They read broadly. They understand different perspectives. They recognize what they don't know. Fifth, they maintain emotional distance. They don't check prices obsessively. They don't let portfolio values dictate mood. They remember that wealth building is a marathon, not a sprint. Sixth, they prepare for multiple scenarios. What if prices fall further? What's the plan? What if prices recover sharply? What's the plan? Having thought through various possibilities reduces the likelihood of panic decisions when scenarios unfold. Seventh, they focus on what they can control. They can't control market prices. They can control position sizing, time horizon, ongoing learning, and emotional responses. This isn't exciting. It doesn't make for good social media content. It doesn't promise quick riches or dramatic reversals. But it works. Over time, across cycles, this approach builds and preserves wealth while the majority of investors chase returns and compound mistakes. The question is, which type of investor will you be? We've covered a lot of ground. Let me bring this together. Gold and silver prices have corrected sharply. This is painful for current holders and confusing for potential buyers, but it's not unprecedented, not unpredictable, and not necessarily indicative of a fundamental shift. The macroeconomic conditions that make precious metals relevant for certain investors, sovereign debt, monetary policy constraints, currency dynamics, geopolitical uncertainty, remain largely intact. The short-term technical and sentiment factors that cause this correction, positioning, real rates, dollar strength, leveraged unwinds, are exactly the kind of dynamics that create volatility within longer-term trends. We don't know what happens next. Anyone claiming certainty is misleading you. What we do know is that markets cycle, that volatility is normal, that emotional reactions during volatility usually destroy value, that disciplined risk management and long-term thinking matter more than timing. If you hold gold and silver as part of a thoughtful, diversified strategy, this correction doesn't change your fundamental reasoning. Maintain perspective, avoid panic, stay focused on your long-term goals. If you're considering an allocation to precious metals, don't rush. Understand why you're buying. Size positions appropriately, build gradually, remove timing pressure. If you're on the sidelines, use this as an opportunity to educate yourself without the pressure of having capital at risk. Understand how these markets work. Understand their role in portfolio construction. Then make informed decisions based on your situation. Most importantly, remember this. Understanding cycles and maintaining discipline matters infinitely more than reacting to noise. Financial media will continue generating urgent headlines. Social media will continue amplifying extreme voices. Prices will continue fluctuating day to day. Your job is to filter signal from noise, to make decisions based on fundamentals and time horizon rather than fear and greed, to build and preserve wealth methodically rather than chasing it desperately. This moment, right now, during uncertainty and volatility, this is where successful investors separate themselves from the crowd. Not by knowing the future, not by timing things perfectly, but by maintaining composure, thinking clearly, managing risk intelligently, and staying committed to sound principles. The crisis isn't in the market. The crisis is in how people respond to the market. You can't control the former. You can absolutely control the latter. Stay informed, stay disciplined, stay thoughtful. That's how you navigate uncertainty. That's how you build wealth over time. Thank you for watching.